So this class is solely dedicated towards understanding price action, which is really the study of past and present. There's some technical analysis that really is a study of the past, but price action really doesn't just look at the past and say the past is a marker for what's going to happen now. It looks at what the market's doing in the real time right now, because that's the closest expression to what's happening in the market and what's most likely going to happen in the next upcoming moments, especially in relationship to your trading. Remember, when we're trading, we're always trading the right side of the chart. We're using the current candle on the left side of the chart to give us information, a perspective, and help us understand it. But the bottom line is that we're always trading the right side of the chart. And that becomes a little bit tricky because in reality we don't know what's going to happen. But we can use the study of price action to glean information, to kind of extract information from the market in terms of what the market has been doing, what it has done, and what it's most likely to do. But we can't do that solely from just looking at candles and their shapes and structures and everything like that. Just looking at that as by itself, the physical appearances of those candles is what we call structural price action. And that's where we're looking at the pure structure, the physicality of what these candles look like. How long is the wick? How short of it? Where is the open, close, highs and lows? What color is it? Do they relate to, do they signify certain things? Is it a head, shoulders, or a triangle? For the largest portion of technical analysis in the history of the study of price action, the largest majority of it, or the most recent history within the last 30, 40 years, has been dedicated towards the physical structure of it. And that wasn't always the case, and it was a little bit different before we had computers. Why was that? Because they didn't have computers, they had to kind of look at things from a purely numerical perspective. And then they had to kind of create an image in their mind of what that looked like, but they weren't necessarily creating images like the ones we're looking at today. Like if you were to tell them a bunch of prices for the current day's candle or anything like that, or the last 20 days or the last period, they didn't necessarily turn those into images in their mind and then that image would be reflective of this. They were looking at price action from a perspective of, okay, who's buying it? How much is it being bought up or sold? How consistently is it being bought up or sold? How close were things to the highs and lows? They were concerned with some of the same things that we get concerned with when we look at it visually, but that was not all they were concerned with. They were concerned with how it was being bought or sold over time. There's a couple really good pure price action traders from back in the day. There are several, but a couple of good ones would obviously be Jesse Livermore, and also there's a guy who has a name, he has a pseudonym called Rollo Tape. Look up his book and you'll see who I'm talking about. So it's a little mystery for you. But they used to trade off of just looking at numbers, and then that translated into them the order flow that was behind those moves. And that's what I wanted to get to, which is that we want to avoid being caught up in just the visual information and then have that be the end all of it, that the visual structure of it is the be all end all of the information that's communicated to us. We want to look at it as what kind of order flow behind that could have created such an environment, because the bottom line is that's what moves the market. And so we can get into arguments about roll the tape. Yeah, no, it's Rollo Tape is what his name was, and it's a pseudonym. So But we can get in all kinds of arguments about technical and fundamental and this and that. But none of that really matters. None of that, it doesn't really matter why somebody buys and sells. Keep in mind, in the U.S. alone, there's 150,000+ retail accounts, and then we have institutional accounts, and then we have Europe, and they're far more active currency traders than we are here, or that many Americans are. And then you have a lot of people from the Asian region and then the Middle East region. So, we're talking well over a few million accounts, both institutional and retail. And with that being said, there's going to be a million whys. Some of those will overlap. Some of them will be the same. Some of them will be completely different. There's a crazy story that this one guy at this one broker, this guy was trading. He was a big Canadian businessman, huge Canadian businessman, very successful, worth millions and millions of dollars. And he had worked for this one broker that I know very well. And what happened was this guy had opened up an account, and he was doing really, really well, but he had wild swings. I mean, just crazy swings all over the place. And all he traded was dollar CAD. And the guy was moving so much volume in dollar CAD that he was responsible for approximately 3 to 5% of all the order flow in dollar CAD on a daily basis. That's how much money he was moving. And there were certain points where he was actually moving the market, a good 20, 30 pips. I mean, a significant amount. And so what happened is that, the brokers are kind of watching him, and the liquidity providers for that particular broker had contacted the broker and said, hey, who's this guy? What's he doing? Do you know anything about him? And they didn't really know much about him because he was just a businessman. And, so they tried to investigate to find out, hey, what it is are you doing? Do you have a strategy? So they got in touch with us. Do you have a strategy? He's like, yeah, I got a strategy. And this will blow you away. But there was a little button on the platform, and it represented the signal strength of the internet that he had at that time, and it would be different shades of green and red. And he was basing his signals off of that button, and then also the prices, the color that they had. Now keep in mind, the prices on the platform, if it goes a down tick, it was red, and if it goes green, if it's an uptick, it goes green. And he was basing his entire signals off of that, which is pretty ridiculous because the guy was moving a lot of dollar CAD. I mean, you were to take all of us, multiply our accounts by 10, have all of us trade dollar CAD, and we still wouldn't be moving as much as he was. Well, depends. If it's my trading account, my fund account, that'd be a little different. But the bottom line is the guy was moving a massive amount of dollar CAD. So here's a guy who's moving the market, and his why for moving the market is completely different than all the other whys that I've ever seen out there. But yet the bottom line is his order flow was highly responsible for the market. You can spend a lot of time trying to figure out the whys, and it will be an endless pursuit. It's not like early days of the stock markets when we have so many limited players and so many limited contracts and we know who the big boys are and they can move and things like that. This currency market is so deep and so liquid and got so many players, you will never find the ultimate why the market moves. Because the bottom line is it's the order flow that moves the market, the total summation of buy and sell orders. And however that order flow manifests in real time, whether it's Canadian unemployment, whether it is, back to what I was saying, which is that, you can say it's Fibonacci's or this and this and that, stuff like that. None of that really matters because it's the order flow that's going to drive the market. And so it becomes very important to understand how to interpret order flow as a reflection or a live expression of the order flow that's behind it. And when you learn how to do that, then you can really get a good communication from the market as to what it has done what it's doing now, and what it's most likely going to do in the future. And that's what we do when we understand price action, or we interpret or learn the study of price action. So, with that being said, there is one unique currency pair that has been kind of expressing something that's been pretty clear. If we look at many of the pairs, they've been a little bit choppy, mostly bullish, but within the last few days a little bit choppy. Understandable. We had the holidays over the weekend. We had bank holidays in the UK, and things like that in the US. So, the last section of price action has been pretty choppy. The market is also waiting for the Fed meeting and that information. Same with the sterling. Sterling has been a little choppy. It's been pulling back a little bit. But there's been one instrument that's been pretty consistent as a whole against a multitude of things. And the ones that have been the most consistent really has been the euro against a host of currencies, the pound against a host of currencies, although not as strong as the euro, and the Swiss franc has been pretty strong against a host of currencies. Now, trading currencies is a little bit different than trading, say, a stock or an index. You're really trading two instruments when you're trading a currency. You're trading two currencies. And this is something I've been saying for years, which is that you're trading the various strengths or weaknesses of that currency against another. And what you're looking for is you're looking for polarities where the polarity is really extreme. In other words, really strong against really weak, or really weak against really strong. Trading strong against strong creates a very choppy environment. Case in point, let's take the Aussie dollar. Okay, so Aussie dollar since middle of March has been on a tear. You take Kiwi dollar, which has also been on a tear, in some sense even more of a tear, been a little bit stronger than and around the same time. And then what you do with Aussie Kiwi, which is the cross or result of that, is you kind of get an up-down market. Once we hit March, it's been very choppy. In fact, look at each candle. Blue, red, blue, red, blue, blue, red, blue, blue, red, red, blue, red, blue, red, red, red. It becomes a mess. So if you're holding the position into a new daily candle, you may be going the right direction to start off that day, but then the next day it might reverse against you. That's not what you're looking for. We trade directionally. We pick a direction, north or south, long or short, and we want it to go in that direction and keep going in that direction as much as possible. But when you trade strength against strength, then the battle becomes a little bit harder to decide. If you were to bet on two particular fighters, it would be an easy bet if you knew, that one person was much stronger than the other. Your payout may not be as much in terms of the betting and the way they do odds, but the bottom line is it would be much easier to decide. When it's strength against strength, it becomes a little bit more complicated to really siphon out the details that really communicate, hey, which one's stronger than the other, and then that's the one I either want to go along with or I want to go short the other currency. So I usually look for opportunities where there are going to be times where not all the currencies are going to be exhibiting clear patterns or great environments or anything like that. And so what I start doing is I start saying, well, wait a minute. If as a whole they're not exhibiting exceptional patterns at the moment, especially with the recent choppy market, well then what I want to do is I want to look for unique environments. And a unique environment is when I can find something with an extreme polarity, something that's really strong against something that's really weak, or something that's really weak against something that's really strong. And as a whole, the currency that is kind of suffering a lot right now is the US dollar. Aussie's been killing it. If we look at Aussie dollar on a daily chart, all-time highs or within 10, 20 pips of all-time highs. It's just been, just brutalizing it the last month. We take it the euro dollar, same thing. It's just been pushing hard against it. In fact, almost all year it's been pushing hard against it. It opened at 34-ish, and here we are 46, almost 47. So up 1,300 pips for the year. We take sterling dollar. Sterling dollar, though not quite as strong, is still strong against it. So a lot of currencies as a whole are really kind of punishing the dollar. So the dollar then goes into the weak category because it's been losing against the majority of currencies. Now, the sterling has been doing well against a fair amount of currencies. It's slightly up for the year against the yen, but it's been kind of a rocky road. In fact, trading yen has been very choppy, so I've been very selective when trading any yen pairs. Trading the Aussie, the sterling probably isn't doing so good because the Aussie is just really strong right now. So it's down against the Aussie, but against the CAD, probably, right here it is, right around the same. So as a whole, the sterling is slightly more bullish against the basket than bearish. Euro, a little bit better situation. Against the Swiss, it's barely up against the year, but up a little bit. Against the yen, very similar picture to sterling yen, except it's a little bit higher. It's maintaining a lot more of its strength. It's holding ground. If we compare it against the sterling as a whole, it's also gaining against the sterling as a whole. So the euro has a greater polarity in terms of strength than the sterling does as against a basket of currencies. So we have euro that's been strong. We have sterling, which has been strong, not as strong against the as a basket, but is still as strong. We have Aussie, which is really strong against a lot of currencies. It's up on the year against the yen. CAD, it's probably maintained some decent strength against it, so not bad at all. But there's one instrument that all these pairs are really struggling against, and that's the Swiss franc. The euro, which has gained a tremendous amount against a basket of currencies as a whole, has been struggling really hard to gain against the Swiss franc. So something that is really strong isn't gaining much ground. We take a look at the sterling, which has been a little bit weaker against a basket of currencies, still up overall, but weaker in comparison to the euro, and it's losing a lot more ground against the Swiss franc. So this is a currency that's generally strong as a whole. It's net strong or net positive against its basket, but yet it's suffering pretty deeply against the Swiss franc. We take the Aussie, which is as strong against a lot of pairs as a whole, and it too is slightly underwater where it started the year against the Swiss franc. So we see things that have, again, Kiwi dollar, same thing. So we see a lot of instruments that possess a lot of strength, but that as a net whole are negative against the Swiss franc on the year. And that really communicates to us that in relationship to them, the Swiss franc is probably the stronger currency. We've had an immense amount of crazy things that have kind of kicked off the year, or, were just happened recently in Japan. There's still a lot of risk involved in the market, although there are signs that things are recovering. But the bottom line is the Swiss franc is going up against strength, and it's beating it. So in some sense, the Swiss franc might be one of the strongest currencies as a whole. So we can put that in the very strong category. Strong because when it matches against other strong currencies, it does really well, and it's a net positive against them. So what I like to do is I like to pair that up with something that's really weak. And as we said in the very beginning, US dollar is pretty weak as a whole. And so when we look at the dollar Swiss chart, it's the weakest of all of them. It's at the all-time or within half a cent of the all-time lows against the Swiss franc. And as we can see, the majority of the candles throughout the year have been red. There's only really been maybe 8 to 9 days on the year, and here we are at the end of the fourth month, 8 to 9 days on the year where the dollar Swiss had a very strong gain against, or the dollar had a very strong gain against the Swiss franc. 8 or 9 days out of the last 4 months. That's not too impressive if you want to be on the bull side. In fact, it's really communicating that the market is overwhelmingly bearish and continues to maintain its bearishness against the dollar here, particularly with the Swiss franc. Now, if we look at, so again, some of the things I've looked at are structure, but I like to look at things from a very quantitative perspective. And I like to start on a base level of, I guess, quantitative approach, and then I really amp it up for my own private stuff. And so, one of the things I looked at quantitatively is, well, if I was to count the number of candles, total number of candles, we're talking about roughly 96 candles, between 90 and 96 candles for the year. And over 2/3 of them are red, selling days. They close the day selling. So for the most part, I want to be selling this. If I'm going to be trading it on a daily basis or any sort of basis, I'd want to be selling 2/3 of the time, at least that. But since it's just so overwhelming, it's probably well over 66%. I'd really rather be mostly selling and very rarely buying. Because even when it does buy up, again, we have these two candles, good size, this one's a good size, decent, some other decents, but you're only talking a couple of them, a handful of them that are strong, and the rest are all decent, and then the rest are all really weak. Here, all these little candles here. They're all really weak. So if you get in it on the very beginning of the day or the very low for the day, and then you get out the very high for the day, you're probably not going to make that much. But yet these other selling candles that are more consistent and more frequent, they're happening a lot. They're closing a lot more closer towards the lows. And you're gaining a lot more pips when you do that than as opposed to buying. So I like to put things on a frequency, see where the thing is more dominant in terms of that scale. The right side of it is really bearish and the left side of it's really bullish. And if it's more to the right by a factor of, say, 60-40 or greater, then that's the minimum requirement that I start saying, okay, that's acceptable enough for me to say, I want to take that trade. I know one trading fund that they won't take a signal unless they know statistically that it's 70+% accurate. And because of that, it's not surprising. That's their minimum level of accuracy. And it's not surprising that they are consistently 70% accurate month after month after month. In fact, when you look at their total number of months that they've traded and the total number of months that they're profitable 76.8% of every single month they trade. And that's reflective of the statistics that they use as the minimum qualification for them to make a trade. So I like to have a minimum of 60%, but then I also look at other things like what are my overall risk to reward margins, so with that being said, once I know the R to R, the thing that completes R to R ratios is the profitability. Risk to reward by itself is meaningless unless you know how profitable and accurate it is. Once I know how accurate I can be with these types of statistics, well then I know what I'm working with. I know how profitable I'm going to be as a whole. So I'm looking for a minimum of 60+%. Generally, even then, I still want a couple other qualifiers to go with it to kind of sweeten the deal. But in this case, we have something here. We have something that 66% of the time is going to sell off on any given day. So that gives us a pretty high probability setup here. Now, taking a look at some of the more recent things, the pair has also struggled a lot with holding above the 20 MA. So anytime I see it kind of surfacing above the 20 MA, if it isn't able to maintain strength above the 20 MA, every time it seems to break back below it, it seems to do a good job of selling after that. So these are some possible environments I can look for. Also, anytime it seems to reject off of the 20 EMA, especially for the last, let's see, how many times did it reject off the 20 EMA? One, how many is really rejections here? 6. So out of the 6 or 7 times that it did it, only 2 of the times was it actually able to do it on a bullish candle. All the other times it was able to do it, it did it on a bearish candle. So when it rejects off the 20 EMA, I have a high probability set up there for selling it. So these are just some basic opportunities that I like to look for. And these are some basic quantitative measurements that I like to look at as well when I am looking at the price action. So does some of those things make sense? Does everybody get how I see those things and pull those patterns out and then look for those high probability setups? Do you notice how none of these are taking into account support and resistance, Fibonacci's, or anything like that? There are ways to trade price action without having to know any support and resistance, without having to pull any Fibonacci's, without having to do any of that. There are totally ways to do it. I know in that same fund that I was talking about that pulls those, that has the minimum thing of 70%, I've met with the trader personally several times. The reason why is because I hired him for my new fund. And so, we talked about his methodology, which is very similar to mine actually. And, when he's trading, he's not sitting there going, oh, well, we're at support or resistance and that's an optimizer and this and this and that. No. He's got a statistical pattern. It plays out at X amount of percentage time. He takes that trade if it meets the minimum requirements, and that's it. So there are ways to trade without any of those things from a purely quantitative perspective. And if I had to guess, I would be willing to bet that in the next 1 to 3 years that the price action, the price action style of trading and environment is going to move in that direction. Why? Somebody once recently was talking to me about, I think it was Sterling Swiss. And one of the things they were talking about was, they were talking about this little thing over here and how this head and shoulders pattern never really played itself out. It's kind of a head and shoulders, but in reality, it's generally not a head and shoulders pattern because head and shoulders patterns are usually after a major uprun, and this is not a major uprun. This is the bottom or the middle section of a massive downrun. Usually it would be like we've had a run for, months and months and months, years, and maybe in a couple of years, and then we see head and shoulders at the very top. This is not that. But they were very interested in this head and shoulders. And here's the thing about it. Here's the thing about trading head and shoulders or flag patterns or triangles or pennants or, dragon tails or all these other crazy exotic patterns that are out there. You have so many moving parts for these patterns that it becomes very, very hard to define it. If you're trying to look for a pattern, you want to look for something that has very clear variables and definitions, and that's easily repeatable. But because head and shoulders have so many moving components, by default, it becomes that much more complicated to trade because you have so many more adjustments that you have to make from head and shoulders to head and shoulders. If I was to throw you into a chart that had 20 head and shoulders, and let's say it had like a playback thing on the chart where I could take you back through the first head and shoulders and then see how you trade that, and the second head and shoulders, see how you trade that, and go on and on and on and on, your results would be very inconsistent. Yes, you may be profitable, but they'd probably be very inconsistent because, the head and shoulders are changed in size and shape and all these other things and stuff like that. And so, with that being said, because there's so many moving parts, you're going to have a very inconsistent result of this. And so with that being said, the movement towards quantitative, I think, is a movement that people will embrace and continue to work towards because it's so much clearer to understand it. There are no really extra moving parts. We can define all the variables ahead of time, and there can be very few. Some of the quantitative systems that I have, there are less than 5 variables to define it. Some of them I can define inside 3 candles with 5 variables. That becomes very easy to trade because it's something that is probably more repeatable. It has less candles. It's dependent upon less candles, so it's likely more repeatable. And it's much easier to define it. You know, I can maintain very easily 5 variables over 3 candles in my head. Not hard to do. But when you have all these other variables, it becomes much more complicated. And the moving parts, there just really aren't any. Yeah, the candles may change in size and shape, but the bottom line is there's so few variables to define the pattern that it's so easy to trade. And so my prediction is that price action trading will begin to shift from the next, from here on out for the next 1 to 3 years from a purely structural way of trading it to a much more quantitative way of trading it. One person came up to me recently and he was asking me about support and resistance. And I said, well, here's one of the problems about support and resistance. It's kind of the same thing. You have so many moving variables behind defining support and resistance or supply and demand zones. I can think of a load of questions that would make it very difficult for you yourself to say, okay, I have a very clear supply zone or demand zone, and I can tell you how strong it is. For example, some of the questions that naturalizes, how many times does it have to touch it to be a support or demand zone? 2, 3, 5 times? What happens if it touches it 20 times? Does it get stronger or weaker if it touches it more times? In reality, the answer depends. How much of a breach do we, does it matter or not matter? How long are the wicks? How close do the closes have to be to it, or the opens have to be to it? There's so many questions that come to mind when defining support or resistance or supply and demand zones that it becomes a moving target to some degree. And most people will have a hard time agreeing on it. Saying this is a supply and demand zone, this another person would say, no, it's not because of this, this, and this. But when you have very clear variables for defining things, it becomes so much easier to relate to and understand. And that makes it easy for us as trading, because the bottom line is trading is already complex enough. As I like what Mike Baghdadi said, he said, trading is simple, it's just not easy. And it's true. Trading is pretty simple, but it's not easy. And that's because of the already inherent complexity in it. And one thing that professionals or masters in any field can do is they're very good at simplifying things, both in their mind and in the way they explain it. The best of the best, when you hear them explain something, it sounds so simple. And so that's what, that's why I think the movement is going to be going in this direction. Because the quantitative approach is so much more simple and so much easier to relate to. Doesn't mean that you're going to always be, fantastically great trader with it. But this guy has an 8+ year track record audited, and I've seen the audit, and I even paid for a professional auditing firm to do an audit on that audit, on the firm itself, and the audit to make sure. Paid $7,500 for this firm to do it, Deloitte & Touche, and one of the best firms in the country, in the world, and they confirmed, yeah, this is as legitimate as it gets. And the guy had an 8+ year trading record. And this guy is going to win 76.8% of every single month he trades. Why? Because he's not trading head and shoulders and flags and triangles and this and this and that. Just trading pure quantitative patterns in the market. Simple, easy to define, very high probability setups. And so those are just some of the things that, some of the ways that I like to approach it. And those are some basic qualifiers, and those give me really a way to look at, okay, this is how I want to trade it. So I got a couple questions here. I want to get to the question. We start addressing this here. John T. says, do you know yet what the publication date for your book is? Not yet. I've submitted the manuscript to it and to my publisher, and I think he's on some sort of break. So I know he has it. He's looking at it, but he's a little slow in looking at it. That process could take about a month for him to review the manuscript. Then we'll probably have to make a few adjustments to it. If he likes it, as long as he likes it, we'll probably have to make a few adjustments. That could take a couple weeks. And then from there, the process is they have to do what is called typesetting, where they decide the font and the typeset and everything like that, and they start working at the printing of that. While that's happening, we're simultaneously promoting it. I got a few authors that want to read it. They help to co-promote it. And then from there, we send it out. So at that rate, based on all those details, I mean, writing a book it's simple and it's not simple. It's simple, but it's a cumbersome process, especially if you run a business, an education business, a trading business, a fund, opening up another fund and starting a new, technology company as well. It's a little slower process than if you're just an author. I really understand the whole author's retreat thing now after doing that. So, but with all that being said, I'm expecting probably a late summer release, and I'm kind of hoping that it kind of comes out right around end of August, because September is when the markets start to pick up again. People come back from trading. It'll kind of hit the market when there's a lot of enthusiasm. So my guess is towards end of summer. So hopefully it gives you some idea yet. Okay, Jez says, did you say you use the 20 MA? Yes, the 20 MA is, if I'm ever trading price action, this is the only EMA I use, because I've noticed that the market tends to react or respond to it consistently on multiple time frames and multiple pairs. And so I use that to see how the market responds to that, and then I use that for possible entries and exits or setups. So yes. Eklavia says, how do you catch retracements which goes above the 20 EMA? This is a good question. Let's go back to, I think dollar Swiss might be a good example for this. So how do we catch retracements that go above the 20 EMA or below it, depending on the type of trend that we're in? I actually have kind of a general methodology that I like to use, which is, it's called a with trend failure. And this is how I use the 20 EMA. And a lot of times one of the things I like to align that with is retracements or Fibonacci's in this case. So the first thing is to really find something that's in a dominating, a very dominant environment, either a very dominantly bullish or a dominantly bearish environment. From there, what we're looking for then, if it's in one of those environments, by default, it will be below or above the 20 EMA, one or the other more than the other. If we're in a dominantly bearish environment, by default, it will be a lot more below the 20 EMA than above it. In fact, oftentimes, the 20 EMA becomes a thing that can reject it on pullbacks, a great place for re-entry. It really can become a good gauge for things. So that is what I'm looking for. So I'm looking for the dominant environment, and then I can obviously see that clearly dominant relationship above or below it. Once I have that in place, I'm either going to trade a pure rejection off of it, and there's a couple ways you can do it. You can look for, let's take this last series of moves here. Okay, so what we're working with is this move from here down. We can see it already had a pullback to the 20 EMA. And this has one of the characteristics that I'm really looking for when it pulls back to the 20 EMA or does any sort of retracement, and I'm looking to continue to sell it or buy it in the direction that's already been moving. The general price action, way things go from a price action perspective, is the market tends to move in these series of moves called impulsive and corrective. And I'll actually talk about that very thoroughly in my book and what that's all about. But the general structure of movements is that if you have an impulsive move, whatever direction that is, the corrective move tends to move in the opposite direction, And the general pattern is that an impulsive move, about 75+% of the time, is often followed by a corrective move, which is then, on average, about same thing, 75% of the time, followed by another impulsive move in the same direction as the original impulsive move. That tends to continue until the impulsive move from the, whichever was the original direction to start the leg, runs into an impulsive move counter trend. That is the most common situation, is that impulsive will follow corrective, which will follow impulsive, which will follow corrective, until we run into a counter trend impulsive move. And we see that here. Impulsive, corrective, impulsive, minor corrective, impulsive to continue. And so my guess is that this will probably continue on until we see an impulsive move in the opposite direction. With that being laid out, we kind of have this nice little scenario here. We have a very clear impulsive move to the downside. Then we have a corrective move, which is perfect for trading off of a 20 EMA, because if it's corrective, then that tells you that the buyers in this case really haven't wrestled control from the sellers. And so what that creates is that kind of communicates to you, look, they really are not in control, because if they were, they would be pushing it much more aggressively. They would push it with much more force, and they would be dominating it more from a time perspective. This is why I like to look at price action from a time perspective. Since this little pullback started, in reality, the majority of candles are more blue than red, but it's not a huge difference. We got 2, 3, 4, 5 from here to here, and we're talking 3, 6, 9 candles, 5 out of 9. So you're not talking a massive, you're only talking like 55 to 45% there. That's not massively skewed to one side. And on top of it, some of them are really small. So it tells you that when they do enter the market, they're not pushing really hard. If they had a lot of control of the market, they would be controlling it for more of the time, to where it was like 60, 70, 80% buying in this case, because they would be in such control, they'd never give the sellers a chance to actually sell off and take control of the market, but they would also be pushing it a lot more vigorously. And we're not seeing that. The pushback is pretty mute in terms of the angle. It's very mute. So these are often fantastic ways to sell off the 20 MA when you see an impulsive followed by a corrective move. You can simply wait for a pullback to it and trade off of it, or very shortly off of it, stop just on the other side of it, or you can wait for some sort of rejection, like this one here, and then hope that you get another rejection, as we did here. Look at the high on the day. The high on the day, 93.62. What's the 20 MA for the day? 93.64. So it's very simple. So you can do that. But what happens like in this situation here? Which comes back to the original question. How do you catch your trades which go above the 20 MA after a downtrend? Well, I want to talk about the two things real quick, which is one, very simply, you can pull a fib from that and see if anything lines up, and see if there's a Fibonacci level that's very tightly close to the 20 MA on the other side of it. And we do. We have this one right here. So that's an option. But what we really want to see is, and this is the with trend failure technique that I was talking about, which is that all institutions know this, that when they're in a move, they're in a trend, trends don't just move in straight lines. In our nice, perfect world, we get into a position, the trade instantly goes positive, and it just keeps going in that direction. But in reality, that's not how it always works out. In fact, if you hold a move for any decent amount of time, even on a shorter time frame, the bottom line is that markets, when they're trending, tend to go forward and pull back a little bit, go forward and pull back a little bit, go forward and pull back a little bit. More in one direction than the other because we're in a trend. But the bottom line is it does have those moments. Institutions also know that these are actually great opportunities to buy or sell depending on the trend. If the trend is down, they actually look at pullbacks as great opportunities to sell it, because as long as nothing has communicated that the market is reversing course, well, then it gives them a chance to buy it at a better price and then sell it back down and make more money as it continues to sell further. If they sell it at the top here, and let's say they dump some of their position here, but then they resell it here, that gives them a chance to really make, even though the move itself was maybe 900 pips or 1,000 pips, gives them a chance to make 1,300 or 1,400 pips. It does take a lot more skill, but the bottom line is that institutions know this, so they look for these opportunities to get back in the market at a cheaper price. And so with that being said, what I look for often is with trend failures, which is that the market starts to pull back, maybe it even breaks above the 20 MA for the first time in a long time, but then after it does that, it really struggles. And we see that here, and this is where we can analyze price action. We can see that it really struggles. Take a look what happens. We have this big candle, closes pretty darn close to the highs, which means that they didn't take their foot off the gas for that day when it closed. They were buying the entire day. It closes almost off the highs. And what's the following day? Breaks above the 20 MA for the first time in over a month and a half. Next day it starts to sell off a little bit. It didn't continue. The buyers didn't continue with it. It actually starts to sell off a little bit. Then runs into a little bit of buyers. Then the thing gets bought up a little bit, but then gets rejected by the sellers. The sellers say, no way. You're not getting past this. So they sell it. And then it gets bought up again. And it gets bought up, but then it gets rejected again. And it's a pretty strong rejection, and we know this because the wick far outweighs the size of the body of the candle. So that there was a lot of pressure rejecting this candle. And then it gets sold off, and it gets bought up, and then it gets sold off. To me, when something goes buy, sell, buy, sell, buy, sell, that generally isn't inspiring for me to be on the buy side per se, especially if the prior major move was to the downside. If I'm on the long side and it just keeps stuttering like this, that's not very inspiring to me. That doesn't communicate that these people that are trying to push it up really have good control of the market. So look what happens. It rejects off the fib. It really holds more off the 38.2. It has one little attempt at the 50, gets rejected just shy of it, and then slams back down. And once we break back below this low here, we've never seen it again. And look what happens. It slams back down, has a second red candle. It's the first time it had two red candles in a row, back to back, since it was bought up off these lows here. Since it was bought up off these lows, we hadn't had two back-to-back red candles. Then we have a third candle, opens, barely goes up, sells off, break these prior lows, closes towards the lows. Big communication. Wow, we haven't had three red candles in a row. The last time we did, it was starting another impulse to move to the downside. We've broken these lows. Maybe I want to go short now. And look what happens. The thing goes on a tear since then. That was 400 plus pips ago. So those are what I call with trend failures, where there's a dominant theme in the market. It's dominantly bullish or bearish. It pulls back to 20 EMA, maybe even breaks it, but then really struggles beyond that. It just doesn't gain any ground. And then all of a sudden, the market starts to sell back off again or continue again in the same direction as it had originally. And that's usually what we call a with trend failure. The thing was in a trend, it pulled back, and it showed you that it really just didn't have the strength to handle that pullback, so it fails, and it's another with trend setup there to trade with the trend back on the pullback there. Institutions do this all the time. Most retail traders don't, because it takes a little bit more skill and it takes a little more practice, and it's a little bit nerve-wracking. You know, maybe you were short, you were selling short, making some money on this, and then it pulls back and you begin to doubt yourself. Even though there's very few communications in here saying the bulls are really in control, you begin to doubt yourself. And then you get out of it, and next thing you know, the market continues on in the direction that you'd originally thought it would, and you're really killing yourself for getting out of it way too early. Does that sound familiar? Does that make sense? Anybody ever had that experience before? I'll admit it, I've had it before. Doesn't happen that much anymore, but I still have it from time to time. But it really doesn't happen for me that much anymore, because I have methods that tell me, hey, get in here, get out here, time to take profit here, and this and this and that. And I very rarely find myself sitting there, wow, I wish I had stayed in that a little bit longer, or, ridden that. It just doesn't happen that much anymore. And so, yeah, many of you, it does sound familiar. And so, don't get so rattled by those little pullbacks, especially if the trend is pretty dominant and it still continued to show dominance and very few signs of reversing. Have confidence in your trading that you were able to call the trend pretty good to begin with. You often find that by staying in things a little bit longer, more often you'll probably make more money than lose more money. So as long as you got the original direction right and you already made a fair amount of profit on it, get confident in that. If you want to learn more precise methods, well, that's where I recommend, taking your trading to the next level and study to the next level. Interested in that? I have a few courses on that. So I have to wrap it up now. There's another speaker, I believe, ahead of me, and so please stay on for that one as well. I want to thank you all very much for coming. If you have any questions about what we do, check us out at secondskiesforex.com. And if you have any questions about our courses now, they can take your trading to the next level. Feel free to email me, info@secondskies.com. Until then, I want to bid you all adieu. I wish you good luck trading. Please stay on for the next one. Thank you all for your patience, and I'll see you next week. Take care, everyone.